should be given.
Yeah.
Live stream.
Just wait. Allowing what to. Okay. Right.
Good morning. What is the Bangalore Professor Vaijanathan? Good morning, Professor Vaijanathan. Good morning, Professor Vaijanathan. I think he's on unmute. Huh?
He's in mute.
Mute. So has the YouTube, have they logged in?
Yes, sir. We start.
Those YouTube. So, sir, shall we start? Professor Rangarajan, shall we start?
Yes, we can.
Good morning. Good morning to all of you. Professor Rangarajan, Professor Shailajan, distinguished faculty members, my dear students, ladies and gentlemen. This is the last lecture in the series of 3 lectures as a part of MA second semester macroeconomics course, those students who are pursuing MBA. The previous 2 lectures were on 3 decades of economic reforms in India. On 10th December we had, and growth and policy coordination in the context of COVID-19 on 17th. And now this lecture is on evolving contours of monetary policy. I have pleasure inviting Professor Shobha Rani, SSV, chairperson of the society. Now, the objective of monetary policy is to achieve price stability, financial stability, and economic growth. Though monetary policy challenges have been changing over time, the perennial concern has been that of the efficiency of the transmission mechanism. That's the crucial word. Understanding of transmission mechanism is very important. We need to know how far the policy signals of RBI are picked up by the banks and how far the signals are sent out by the banks to impact the real economy. Ultimately, we want changes in the real economy, changes in the level of employment, etc. We need to know in which areas monetary policy is more effective, and in which areas fiscal policy is more effective. And to decide for the governments to have that optimum policy mix jointly by the Reserve Bank of India and the Ministry of Finance. Some questions which come up to our minds are, there is a monetary policy committee which is there. So has the introduction of this committee helped Reserve Bank of India to frame monetary policy more effectively? Is monetary policy more effective in developed countries than in developing countries? Does monetary policy control only core inflation, leaving out the general inflation? Because our concern is for general inflation. Core inflation is the only part. How do we control the general inflation, which also includes food and fuel prices? Does monetary policy control only core inflation? What are the challenges posed by the cryptocurrencies, which we hear every day in the newspapers, in the effectiveness of monetary policy? Finally, we are now going through national education policy, which focuses on interdisciplinary approach. Now, the students of MBA second semester are studying both macroeconomics and finance. The interesting question is, what is the relationship between macroeconomics and finance? Every MBA student should know this link. Do not study them as silos, but they are linked. What that link is, you must know. Every MBA student should know this. Now, I request Professor Rangarajan to speak for about 40 to 45 minutes, followed by a Q&A session. We request you, the distinguished members, students and faculty, to type your questions in the chat box so that we can sort out and ask if just 2 or 3 questions to Professor Rangarajan. Floor is yours, Professor Rangarajan. Welcome.
Thank you very much, Dr. Reddy. I propose to talk to you this morning about the emerging contours of monetary policy. Monetary policy is one of the important instruments of economic policy. Monetary policy includes all actions by the monetary authorities which have a bearing on the cost and availability of money and credit. We need to define what monetary policy is before we can discuss about its implications, its impact, and many other aspects of policy making in relation to a monetary policy. Therefore, as I said, that the actions of the monetary authorities influence the economy through changes in the cost and availability of credit and money. When I say availability of money and credit, it essentially means the money supply and the extent of credit that can be made available or that is made available by the system. Cost of money or cost of credit is what you all know is a rate of interest. Therefore, by acting on both interest rate and on money supply, or sometimes people are fond of calling it liquidity, they try to influence the economy. So this is what monetary policy is about. We really need to understand what are the key issues that arise with respect to monetary policy making. Some of these issues were mentioned by Dr. Reddy already. When we analyze any instrument of economic policy, there are three aspects which we need to understand and clarify. One, what are the objectives of monetary policy? Second, what are the instruments that are available to monetary authorities to bring about the changes that they have in mind? And third, what is the effectiveness of the policy? As I said, objectives, instruments, and effectiveness apply to any policy instrument that you look at it. Of the various policy tools that are available to policymakers, they are broadly classified into three categories. One is monetary policy, and the other is fiscal policy, and the third is direct controls. I mentioned already that monetary policy influences the economy through changes in interest rate and money supply or liquidity. Fiscal policy influences the economy by acting on revenues and expenditures. Fiscal policy is a more direct instrument because their actions immediately affect the income and expenditure stream. And the third category is what is called direct controls. If, for example, the government wants that the people should consume less liquor, they can just ban the production and consumption of liquor. That's direct control. Therefore, planning essentially, as it existed in India prior to 1991, was of that type. For production of anything or for the distribution of anything, some permission or some permit was required, and the government can act through the issue of licenses and permits. This morning, we are concerned with monetary policy, and we will come back a little later to link with fiscal policy. What are the objectives of monetary policy? In a broad sense, all the objectives of economic policy are also the objectives of monetary policy. Where do we go to find out the objectives of monetary authorities? The monetary authority in almost every country in the world is called the central bank. We have the Reserve Bank of India in our country. There is a Federal Reserve System in the United States. There is a Bank of England in the United Kingdom, and so on. Bank of France in France, and so on. In the European Union now, there is the European Central Bank, ECB, as they call it. So the legislations setting up these institutions might have stated in the preamble the objectives of creating that institution. But one problem with the legislations is that they are often too broad and do not convey in very specific way what the goals or objectives of monetary authorities are. Let me quote from the Reserve Bank Act of 1934, which set up the Reserve Bank of India. The original preamble, which was amended very recently, I will come to that later. The original preamble said the institution was being set up, to quote, with a view to securing monetary stability in India and generally to operate the currency and credit system of the country to its advantage. This is the most generalized statement. It only says the Reserve Bank of India should be a good institution. That's all. It doesn't make anything very clear. There are no specific objectives mentioned here. But there are other central banks for which the objective is somewhat made somewhat clearer. For example, the Federal Reserve System in the United States has been set up, and to quote what the preamble of that act says, so as to promote effectively the goals of maximum employment, stable prices, and moderate long-term interest rates. There's a bit of a confusion in this statement. Long-term rate of interest is not the objective. It's only an instrument. Therefore, it talks about, as objectives, maximum employment and stable prices. This is one of the controversial aspects of monetary policy. Does the monetary authority have multiple objectives? Or does it have a single objective? Or if there are multiple objectives, how does the monetary authority handle it? Generally speaking, the two objectives before the central banks are growth and price stability. When the European Central Bank was set up, it stated somewhat more clearly which takes dominance. Let me quote from the preamble of the European Central Bank. The primary objective of European Central Bank shall be to maintain price stability. Without prejudice to the objective, it shall support the general economic policies in the Union in order to contribute to the achievement of the latter's objectives. That is, it says, shall be to maintain price stability without prejudice to that objective. It shall support the general economic policies in the Union. It does not exclude growth as an objective, but it says that price stability is the dominant objective, but it can also take into account the other economic policies of the states. So this in a sense makes it important because unless the objectives are clear, it's really very difficult to judge the actions of the central bank. Very recently, the Reserve Bank of India Act was amended in 2019. And what it said in the preamble was, it retained what was said before, with a view to securing monetary stability in India and generally to operate the currency and credit system of the country into its advantage. And then added, whereas it is essential to have a modern monetary policy framework to meet the challenge of an increasingly complex economy. And whereas the primary objective of the monetary policy is to maintain price stability while keeping in mind the objective of growth. So you can see that it says a primary objective is price stability, but it also adds by saying keeping in mind the objective of growth. So this does, in a sense, make the task of the monetary authority more difficult, but perhaps the task by itself is difficult because the monetary authority cannot exclude certain objectives. Let me elaborate further this idea and see what it implies. Why is the definition of objective important? These days, we talk about the autonomy of the central banks. Autonomy goes with accountability. And accountability needs a clear enunciation of objectives. And that is why a clear definition of the objectives is very much needed. Then only you can judge the performance of the institution. One can ask the question, why do multiple objectives pose a problem? What is wrong in saying, let's have both growth and price stability as the objectives? Or financial stability, as I'll come to it later. The problem with multiple objectives is that there could be an inherent conflict among them. If all objectives can be pursued simultaneously without one objective coming into conflict with the other, then multiple objectives do not pose a problem. Multiple objectives pose a problem only because there are inherent conflicts among objectives. Then what do we do? That is why we really need, when there are multiple objectives, a hierarchy of objectives. Which is the most dominant objective and which is the next important objective. Some hierarchy is needed. And also, in the realm of what is called policy analysis, there is also a principle called assignment principle. That is, when there are multiple objectives of economic policy, not only monetary policy, economic policy, the question to decide is which instrument is best suited to meet which objective. Perhaps one could say monetary policy is a better instrument for achieving the objective of price stability. Fiscal policy is better to achieve the objective of growth or something like that. Therefore, the assignment rule essentially talks about which objective should be taken care of by which instrument. The literature, there has been a lot of discussion about what is called the Phillips curve. Students of macroeconomics will know that. The Phillips curve thought in terms of what they call the trade-off between growth and price stability. I hope you understand trade-off. Trade-off essentially means if you want to get more of one thing, you should get less of another. If you want to have a higher growth, probably you should be willing to let the inflation also go up. So what really they had was the Phillips curve, in which what was related was on the horizontal axis you have unemployment, and the vertical axis you have inflation, let us say, and the curve will be downward sloping curve. That is, according to the Phillips curve, the lower the unemployment rate you want, the higher may be the price level. That is, as some people say, you buy growth with inflation. You allow for a little more inflation, and therefore you get a little more growth. Now, that is the kind of trade-off that people talk about. So I will not go into the niceties of the Phillips curve enunciation and how it has been discussed in the literature. Basically, what happens is that as some people have said, if expectations are built into it, there may not be a trade-off between the two. Or to put it in other words, there may be a trade-off in the short run, but there may not be a trade-off in the long run. Now, let's look at it in terms of growth. When will growth be faster over a long period of time? Over a long period of time, the country really needs an environment of price stability so that savings will accumulate more and therefore growth will happen. But in a short period, there could be a trade-off. Therefore, the most important thing to understand is that what we do in the short term should not come in the way of our long-term goal. There is a rule called Taylor's rule, which many central banks talk about. The Taylor's rule is, how does the policy rate of a central bank fix? When the economy is operating at a level which is above its capacity, that is what we call overheating of the economy. At that time, the economy is fully utilizing its capacity. At that time, you really want to slow down the system, and that is why you raise the rate of interest. Similarly, when the price level is, or the rate of inflation, not the price level, the rate of inflation is higher than what is being accepted or what is acceptable, if it is running at a higher level over what is acceptable, then you raise the rate of interest. To put it in other words, what we are essentially talking about is when the economy is operating below its capacity and when the growth rate is somewhat stagnating, then you lower the rate of interest. Similarly, when the price level is below the acceptable level, then also you can lower the rate of interest. So this is the broad Taylor principle that many countries adopt. Before I go further, we all understand why growth is an important objective. That doesn't require any explanation. We want a higher standard of living. The quality of life must increase. And therefore, what is actually desired is a higher rate of growth in the economy. Why do we need price stability? Price stability we need because, as I said earlier, only in a situation of reasonable price stability, savings will come. In an environment of fluctuating and rising inflation, investments may get diverted into speculative activities because everybody is trying to make money out of just the increase in the price level. Therefore, it is also felt by most people that price stability is equally important. And this kind of discussion has led to two concepts. One is what is called threshold level of inflation, and the other is inflation targeting. The latter one, you must have heard being mentioned quite often as India adopted inflation targeting after 2019. The concept of threshold level of inflation is let each country decide, or not decide, let each country find out from the way in which its economy is behaving, what is the level of inflation beyond which, if inflation continues, it affects the economy adversely. That is the threshold level of inflation. Below that level, when inflation goes up or goes down, one is not bothered. But if inflation crosses the threshold level, there is a fear that it is not desirable. So it is for the concept of threshold level, the concept of inflation targeting came. The Reserve Bank of New Zealand was the first country to adopt inflation targeting in 1990. Thereafter, many other countries have adopted. Federal Reserve System in the United States does not have a stated inflation targeting, but by implication, they act that way. In developed economies, inflation beyond 2% in a year is considered to be undesirable. But we in India have a greater tolerance for inflation. The inflation targeting mechanism that was introduced in 2019 in India says that the central bank of the country should keep inflation at 4% per annum, plus or minus 2%. That is, the Reserve Bank of India should try to see that inflation does not go below 2% and inflation does not go above 6%, and virtually work towards, on an average, an inflation rate of 4%. This 4% inflation rate is something like the threshold level of inflation that I talked about. Why do we give flexibility? The need for flexibility, or the margin, as some people call it, the comfort zone. 2 to 6 is a comfort zone, beyond which, particularly when it goes up, is undesirable. The reason for giving a margin is that it is always difficult to keep inflation at one single level. And there may be some reasons why suddenly, let us say, there is a drought in the country. Monsoon has failed. Agricultural output has fallen. Then prices may rise. But it may not be possible to act immediately to bring it down. Therefore, some leeway is being given. And that leeway is given in terms of the margin that is allowed. And second, also, any action that monetary authorities take, or monetary authorities introduce, take time for it to be felt on the system. Therefore, for two reasons. One, there can be sudden jerks in inflation, particularly because of the supply side factors. And that is one reason for giving flexibility. The second reason for giving flexibility is that that it takes time for the actions of the monetary authorities to achieve the result. Before I elaborate further, I need to go to the second one, which I call the instruments. Because when you give the objective of inflation targeting, the first question that will rise in the mind of the people is, can the central bank control inflation? Is the control of inflation possible through the instruments that are available? What are the instruments that are available to the central bank of the country to bring about changes in inflation or growth? I said the actions of monetary authorities influence economy by changing interest rate and money supply or liquidity. Changes in interest rate are brought about by the central bank of the country through certain policy instruments called in India what is called the repo rate. When the repo rate of the Reserve Bank of India is increased, then it is expected that the banks will in turn raise the rate of interest on either their borrowing, which is the deposit, and their lending. What is a repo rate? Repo rate is a rate at which the central bank of the country lends to the commercial banks when the commercial bank go to the central bank for borrowing. Therefore, when the cost of borrowing for the commercial banks from the central bank increase, then they also increase their lending rate and also their borrowing rate, that is the deposit rate. That is one way to do it. The other is what is called open market operations. What are open market operations? When the central bank, let's say, comes to the market and buys government securities from the banks, let us say. Banks are holding government securities. When the central bank buys government securities from the commercial banks, what happens? They pay for it. Therefore, the central bank money goes into the hands of the commercial banks. And therefore, their liquidity expands. And therefore, they can use the additional liquidity provided by the central bank to lend more to the people. So, on the other hand, when they want to contract liquidity, the central bank, out of its portfolio, sells government securities. At that time, the commercial banks pay out of their resources to the central bank. And therefore, their resources contract. So, changing the policy rate, buying and selling government securities through open market operations are the instruments through which, or the mechanisms through which, the central bank influences the system. There are lags in this. First of all, there is a lag between the action of the central bank and the action of the commercial banks. When the central bank announces today to raise the policy rate, the commercial banks may take a little time to adjust their interest rates. That is what is called inside lag. But the outside lag is what happens? When central bank expands credit or contracts credit, what happens? When they expand credit, more credit goes into the business units, and therefore they can expand production, and the output in the system goes up. As I told you earlier, whenever the monetary authority wants to stimulate the economy, they lower the rate of interest. Therefore, when the commercial bank lowers the lending rate, the borrowers, that is the business units which borrow from the commercial bank, borrow more because the rate of interest has come down. And with that, they expand their output. And that results in an increase in the total output in the economy, and that brings down the inflation. So this is the way in which it is supposed to operate. So there could be lags in that also, because the increase in output does not happen immediately. First, business units need to borrow from the commercial banks. Then after they have borrowed from the commercial banks, they have to expand their output with the credit that is made available. And that is when the final effect will come about. So the question to ask is whether all these things will happen according to textbook, as they say. Will central banks act? No, I'm sorry. Will commercial banks act immediately after the central bank? You remember some time ago, there was some concern that when the Reserve Bank of India lowered the rate, the commercial banks did not lower the rate immediately. They used to say the commercial banks were not passing on to the economy what the central bank has done. This could happen for a variety of reasons. And the second reason is that will the borrowers, that is the business units, react immediately to the changes in the rate of interest, and whether they will expand or contract their output depending upon the changes in interest rate. This issue keeps coming up from time to time because how much does interest rate count in the actions of business units? Will they immediately respond to lowering or raising of the rate of interest? Sometimes they may, or sometimes they may not. And there is also an asymmetry. When the central bank raises the rate of interest, and then the commercial banks also raise the rate of interest, then it pinches the borrowers, the business units, more strongly. Therefore, it is said very often that the banking system or the entire financial system has efficient brakes, but the accelerator is uncertain. I hope you understand what I mean. Because when the rate of interest is raised, then banks, then the business units have to react. But when the rate of interest is lowered, the business units may borrow more or may not borrow more also. It is like the old case. We can take the horse to the pond, but cannot compel it to drink. The banks may make available more credit to the business units. But whether they will bite it or not depends upon business units' expectations of the future, whether there is sufficient demand for the product that they are producing, and so on. Therefore, there is some belief, not belief, there is some reason to believe that there is asymmetry in the way in which monetary policy may operate. I'll come back to it shortly when I discuss monetary policy in the context of COVID-19. So the point that I have been trying to say so far is, broadly speaking, there are two objectives of monetary policy. One is to promote or contract growth, and second, to maintain price stability. The two do not always go together. At least in the short run, there is a trade-off. And the two major instruments available to monetary authorities to influence the economy are, one, the policy rate, the repo rate as we call it in India, and the other is open market operations. The question about availability and cost is critically important. The impact of the actions of the monetary authorities on the economy also depend upon the reactions of the business units to changes in interest rate. Now, there is another thing. People talk about financial stability as an objective of monetary policy. After the 2008-9 world crisis, where the economic downfall of the developed countries like UK, USA, and others happened. Because the financial system collapsed. And with the collapse of the financial system, the real system, when I say the real system, it means the output system also collapsed. Therefore, there is a big link between the way in which the financial system operates and the way in which the real system operates. Why did the financial system collapse in the United States first? It is because the banking system had overextended credit. The central bank in the United States, the Federal Reserve System, maintained a low rate of interest for a long time. This led to big risk-taking by the borrowers, and the banks also provided larger amount of credit. This extraordinary increase in credit to the real system had to collapse beyond a particular point. And when that happened, the real system also collapsed. Therefore, people think in terms of financial stability also as an objective. But financial stability, another word for it is to maintain the soundness and safety of the financial system. The safety and soundness of the financial system is maintained to a large extent by what? For example, the banking system. It is through supervision and prudential controls. Therefore, it is not directly monetary policy which is relevant. But monetary policy also played a part, because when the monetary authorities try to keep the rate of interest at a very low level, there are many people who are willing to take risks. All right, we can borrow from the bank and do this because the rate of interest is low, I can take the risk. And when there is too much risk taking, that can also create problems. So financial stability is important, but to a very large extent, the maintenance of financial stability is dependent upon the actions of monetary authorities as regulator of the financial system. In most countries in the world, the monetary authority also functions as a regulator of the financial system. They don't regulate the capital market. In India, the regulator of the capital market is SEBI. But the regulator of the banking system, the regulator of the money market, the regulator of the credit system, the regulator of the non-bank finance companies is the Reserve Bank of India. Therefore, prudential norms of various sorts, like capital adequacy, income recognition, and so on, are important. And the regulatory authority has to supervise the functioning of the institutions. People also talk about exchange rate stability as one of the objectives of monetary policy. We don't have the time. I will not go into it. But largely speaking, when people talk about objectives of monetary policy, the issue that arises is the issue centers around growth and price stability. So what we have seen is about the objectives, about the instruments, and the capabilities to bring about changes in the desired way by the monetary authority. Let us quickly see how we apply these concepts to the current situation. After the attack, advent of COVID-19, one important policy decision that was taken by the government was to bring about lockdown in order to prevent the spread of infection. As a consequence, output fell. And then when they wanted to restart the economy, or the term used is kickstart the economy, the most important advice that is given to the government was to use fiscal policy. The advice that was given to the government is increase expenditures. What kind of expenditures? We talked about, some of you might have listened to my earlier talk on COVID-19. That is, increase healthcare expenditures, including vaccine, extension of hospital facilities, buying equipment like the oxygen supplies, and so on. The second is to take care of the people who have been affected immediately, like wage earners, including migrant labor. And third, government expenditures to stimulate sectors of the economy which have been badly affected. MSMEs, small and medium enterprises and micro enterprises, needed special support. The hospitality sector suffered a great deal because with the lack of mobility in the movement of people, the tourism industry was affected, and then the hotels were affected, and so on. So increase the expenditures. It also created a big problem because output was not increasing, and therefore revenue was not increasing. When the government was advised to increase expenditures, that was a time at which the revenues were also not increasing. Then people said at that time, print notes or go to the central bank and get credit from them and use that credit for the purpose of stimulating the economy. Hold on, you keep that in your mind. Now I'll come directly to the monetary authority. What is the monetary authority supposed to do? As I said, the economy was operating below a level. You all remember there was a contraction of the economy in the first year, in 2021. Therefore, in 21-22, it was expected the economy will pick up. And in order to enable the economy to pick up, more credit should be made available. And as I think mentioned to you last time, there were three kinds of steps taken by the monetary authority to stimulate the economy. One was to lower the repo rate, interest rate was lowered. Second, liquidity was injected through various mechanisms. And third was regulatory forbearance. Let's go back 1 and 2. That is precisely what I was talking to you earlier. If the monetary authority wants to stimulate the economy, they have to lower the rate of interest, and that means they make available more liquidity to whom? More liquidity to the banks in the first place, and the banks will use the additional liquidity that has been given to them to provide more credit to the borrowers, that is the business units. So this is the way in which all central banks world over have behaved. COVID-19 is an emergency. COVID-19 had created an extraordinary situation that had to be handled. And therefore, the economy has to be kick-started. And for that particular purpose, the central bank must make available more liquidity to the banking system which in turn will provide more liquidity to others and also lower the rate of interest. I talked about a few other things. If you recall, if those of you who have attended the last lecture will know. What's the problem in printing notes? The problem with printing notes is that it will increase the demand, so to say, because more liquidity is made available by the banks or by the government, because very often the first person to gain as a result of printing notes is the government. It will increase the expenditures. When it will increase the expenditures, income in the hands of the people will go up. The employees will get more. When they buy ventilators, the makers of ventilators will gain. When hospital facilities are extended, those who construct the buildings will gain, and so on. Therefore, it leads to that. But unless output also increases as a consequence of this, you can get into a period of inflation. So that is one of the things that the Monetary Authority has to bear in mind. Namely, while the needs of the day are in one particular direction, to increase government expenditures and to facilitate government expenditures by providing more funds directly or indirectly to the government by the central bank, all that is needed. But that action can also result in the inflation happening. And that is why, as you all know, many of the central banks in the developed world are now reversing the gear. Until a month ago, they were also providing additional liquidity. They were also lowering the rate of interest. In the United States, the Federal Reserve System has announced that they will steadily reduce the injection of liquidity into the system, because the inflation in the United States is way above the 2% level that they used to maintain before. In India too, the inflation is not at 4%. It is much more around 5% and 5% plus. There was a time that the inflation in India was also above 6%. Therefore, this needs to be kept in mind by the people, by the monetary authorities. So to summarize, I talked about the objectives of monetary policy, the instruments that are available with the monetary authorities to bring about the changes that they think desirable. And third, we also talked about the effectiveness of monetary policy in terms of influencing the level of the economy. Before I conclude and take up some questions which you may have in your mind, I want to conclude by saying it is sometimes said that central banking is neither a science nor an art, but a craft. I must say, this is at best a half-truth. Central banking is no longer the application of well-known tools to well-known problems. The issues that surface are very complex. We need to continually enlarge our knowledge and understanding of how the economy functions, how the different participants of the economy react to policy changes, in this case, react to policy changes introduced by monetary authorities. Successful central banks are those which respond to problems with speed, tact, and intelligence. Thank you very much.
Almost an hour we have spent, we have spent on this fantastic lecture. We have spelled out the objectives of the monetary policy as well as the fiscal policy and the instruments which are there for implementing, using them for implementation. We have talked rightly about the inflation targeting and how it is used in the developed countries and the Indian context of 4 ± 2%. We are focused on financial stability as an important factor and the importance of fiscal policy and where it should be used as against the monetary policy. And you have answered the question of link between finance and the real sector, the financial sector and the real economy. So now we are left with another 10 minutes or so for questions. So we will take up we have received first question is this 4% inflation target which we are thinking of, which means either 4 plus or minus 2, does it relate to core inflation or general inflation? Does monetary policy affect only core inflation or general inflation? How does the interest rate cut impact the economy? You have mentioned it in your speech, but maybe some want further elaboration. Thank you, sir. This is number one.
4% is general inflation. It is not core inflation. That is sometimes called the headline inflation. That is, it's the overall inflation. Sometimes the food inflation can be high, but it is very often argued when food inflation is high, then it tends to affect other prices in the commodities also. Like wage increase happens, and when wage increase happens, then it affects the entire system. Therefore, the main point is that it is it is a general inflation that we are talking about. I spent a greater part of my time in trying to explain why inflation affects, why monetary policy affects inflation, and influences inflation, not affects, influences inflation. Basically, it is through the channel, which is called the transmission mechanism, of the availability of credit and interest rate. So long as business units, which includes agriculture also, depend on the financial system to obtain credit for the purpose of production, the availability of credit and the rate of interest are critically important in their activities. Therefore, when the rate of interest is raised or lowered, businessmen and agriculturists also react. Therefore, the channel is primarily through the rate of interest and the availability of funds. That is what we call liquidity. As I explained earlier, when the rate of interest goes up, it is like applying a brake. When the business units tend to borrow from the banking system, then they have to pay a higher rate, and therefore they borrow less, and then the output is brought down. On the other hand, as I mentioned earlier, when the economy needs a stimulus, the rate of interest is lowered or more credit is made available, then it helps to expand production. But once again, as I said, it depends upon the reactions of the business units. So this is a way in which it influences. Well, since in the banking system or in the financial system, much of the credit is going to the industrial and other service sectors than to agriculture. Probably when monetary policy changes happen, they affect much more quickly and directly the non-agricultural sector than agricultural sector. Agricultural sector is very often influenced by climatic conditions, weather conditions, and so on. But certainly, agriculture is also influenced by the level of interest rate and the amount of credit. Very often, the policy makers, I would say political policy makers, announce waiver loans to agriculture, because that is considered to be essential in order to enable agriculture to move forward. Therefore, you cannot say agriculture is not influenced by changes in interest rate. In fact, the argument always has been that agriculturists, particularly the small agriculturists, should be provided credit at a concessional rate of interest. So the point that I make is, it is a general inflation that one is concerned with, because the focus on core inflation comes about in many, it happens in many countries because they think that the actions of monetary authorities have greater effect on what is called the core segment than the non-core segment, like agriculture and oil in the Western countries. But when we talk of inflation, we talk of headline inflation, inflation including on food products, and monetary authority is concerned with overall inflation.
Thank you, sir. Sir, there are three students have asked three questions very related. Rather than separately, I will put them together. You see, one is, what is the major reason for maintaining inflation target rate between 2% to 6%? That's the Indian. What happens if we cross inflation target of 6%? The second student has asked what problems RBI is experiencing to achieve price stability, which is one of the important objectives of monetary policy. Finally, the third is also related to this. Out of all the major tools of monetary policy, which one is the most important one?
Now, the point really is, many studies have been done to find out what is the threshold level of inflation. I have also written papers on the subject. As I said, in the United States and most of the developed countries, 2% inflation is considered to be acceptable. We are treating actually 4% as acceptable, because inflation target essentially means over a long time, over a long period, that inflation should be around 4%. Tentatively or temporarily, it can go to 6% or it can go to 2%. In fact, let us not look at the 2%. That is not a big issue in our country. I think it never falls below 4%. If we get 4%, we are really very happy. Sometimes when inflation goes up by a very high level, then the next year it may fall. But largely speaking, the critical point is 4 to 6% in a developing economy like ours. The point is to find out the estimate of what is considered to be the threshold level of inflation. We have to examine that by studying the behavior of the economy over a period of time. But please remember, then when developed countries have a target of 2% of the inflation rate, And if we keep in India 6% in external trade, in foreign trade, you'll be priced out very quickly. And the exchange rate of the rupee will fall, because ultimately it is the inflation differential which determines the exchange rate. Because if you have to be competitive in the world, you have to be competitive in prices. Therefore, we really need to take into account. But we really cannot work on a 2%, because very rarely we get that level. For example, certainly agricultural prices fluctuate because they are highly dependent on climate conditions and so on. So the point is, it is not something that is externally determined. Analysts have to study the problem and arrive at what they consider to be the threshold level of inflation, or the best level of inflation, and then give your margin. And there was a committee that was appointed by the Reserve Bank, and that committee came to the conclusion that 4% is a desirable level, beyond which it is not desirable. And let us give the flexibility on either side. What was the last part of the question? I think you had said.
The last part is what problem RBI is experiencing to achieve price stability, which is one of the important objectives of monetary policy.
Well, if you look at the inflation in the post-2019 period, by and large, they have been able to stay within the between 4 and 6. I think that has been quite successful. In fact, much closer to between 4 and 5 rather than to 6. Actually, touching 6 and exceeding 6 has happened only last year, or particularly in 2020. Because of the supply side disruptions in the system, their prices have gone up. And when there is lockdown and there is no production in the system, then prices have gone up. But as I said, many countries in the world today are now seriously thinking, how long can they go on with liberal liquidity policy? The reversal, or as I said earlier, the reversing of the gear has already happened in the developed countries. And perhaps I expect that very soon the Reserve Bank of India will also give a signal.
There is, I think time is up, but we have maybe last word. Will crypto disrupt the monetary policy?
What?
Will cryptocurrency?
No, that requires a special lecture. It cannot be done in 1 minute. I mean, I think it is a kind of a financial asset, which may also serve as a limited medium of exchange. In fact, to call it currency is making it bigger than what it is. Currency means something that is accepted generally as a medium of exchange. That does not happen with cryptocurrency. One thing that you attach as an important value to anything that serves as a medium of exchange, either fully or partially, is stability. That is why we talked about price stability. But you must have noted all those cryptocurrencies which are being traded are fluctuating violently. And therefore, they do not necessarily serve as a good medium of exchange. The other it has actually turned into something that is speculative in character. It is something like an asset, financial asset, which is being traded with a view to making money. Well, one can say that if people want to be foolish and if people want to trade and make money, why do you come in the way? That is true. But then when a lot of people lose money in the process, then the policymakers are also concerned about the adverse consequences on people. Therefore, the critical question to ask is, can we ban cryptocurrencies? If cryptocurrencies are banned, whether there can be a violation of that. Some people tend to argue in the West that banning doesn't work. Therefore, at this particular moment, people are discussing 2 or 3 issues. One, if cryptocurrencies are allowed, what kind of regulation there should be? There are people who take a strong view that cryptocurrencies should be banned. And the question really is that if the ban is introduced, will it be effective and what action will have to be taken? The whole point is that this financial asset is a kind of a fictitious financial asset. And the way in which it operates is based upon a complicated computer network. Not all people fully understand it. The blockchain is as a basis behind these operation of these cryptocurrencies is not fully understood by everybody, particularly people who are not computer specialists. Therefore, the utility of it is in question. Secondly, one has to really think in terms of whether banning is also effective. These are the issues that need to be discussed and need to be understood fully well. On the question of utility itself, there are great doubts.
Sir, thank you very much. The time is up for this. I don't know, even this last question also seems to be we have not yet covered. What it says is, you mentioned that exchange rate stability is also an instrument of monetary policy. Can you please elaborate? Because we have not covered the exchange rate part. So how would you what shall we do?
No. The exchange rate stability was, for example, the objective of monetary policy when gold standard was in operation. When gold standard was in operation, every currency was expressed in terms of quantity of gold. Therefore, the exchange rate automatically gets determined, because if one currency has X quantity of gold and another currency has 2 quantities of gold, then naturally the one is more valuable than the other by 2 times or something like that. But the question really is, at that time, the monetary system that emerged as a consequence of that was that there was the famous rules of the gold standard. Expand credit when gold comes in, and contract credit when gold goes out. That is a fundamental principle that had to be followed. And that is when I said that exchange rate stability and objective of monetary policy. But nowadays also, people do not think that exchange rate stability is something that can be ignored. Now, exchange rates are determined in the market. Market may take into account several considerations while determining the exchange rate, or while trading in the market. Therefore, the issue is that when large capital inflows are coming into the country, but then it has the effect of raising the value of the currency or the country into which money is coming from outside. Then the issue that arises is, should the value of the rupee appreciate because money is coming in from outside? And if the value of the rupee appreciates, it affects adversely exports. And therefore, what should be done? So should the monetary authority expand money supply as fresh resources come from outside? That is, then it has an expansionary effect on the system. When, let's say, a lot of dollar comes into the country, then it forms a basis for further expansion of the currency by the central bank. Then that can lead to a situation in which there is more expansion of currency in circulation or money, total money, beyond the requirements of the economy. Then price level will go up. Therefore, there is an interplay between the actions of monetary authorities and the exchange rate and the inflow and outflow of resources. Sometimes the monetary authority may have to intervene. That is what is called, for example, sterilization. When there is a lot of money coming into the country and expands money supply, monetary authority may undertake some actions like sterilization. Sterilization means buying securities, selling securities, so that money will be sucked out from the system because too much money has gone into the system. But the point really is that in most countries in the world today, exchange rate stability is not taken as an objective of monetary policy. That they want to deal with separately. And many countries in the world, particularly in the developed world, say that let the market decide what the exchange rate should be. But developing countries like India do care about it. And therefore, as I told you, there have been occasions in India when the extraordinary inflow of capital into the country had the effect of expanding money supply, and the monetary authority had to intervene by the stabilization securities or by regular open market operations to contract the money supply. Okay.
Thank you, sir. Thank you very much for clarifying the differential approach to exchange rate for among the developed and the developing countries, and particularly in India. Thank you. We have already exceeded the time. The students have another class to go. So I want to thank you, and I must say that this lecture is attended not only by the thousands of students in ICFAI, but also professors, faculty members from ICFAI University, from Usman University, Central University, and several other distinguished economists. Thank you, sir, very much for this excellent series of lectures. This was a great value for the entire university. Thank you, sir.
Thank you very much. I hope you enjoyed it.
Thank you.